I went from losing every single trade to winning every trade with this one simple technique. And I'm going to show you right now. And before I do, when I first started trading, I had everything lined up. I had my strategy, I had proper discipline, I had risk management, but there was one simple technique I just did not know about and I did not do. And that is called liquidity sweeps. In this video, I'm going to show you exactly how to identify liquidity sweeps and use this in your strategy so that when you place an order, you won't get stopped out quickly and you will actually take profit. Hit that like and subscribe because this is about to be so helpful for you, so beneficial. So hit that like and subscribe. Let's jump right in. All right, you guys, so we're on the charts right now. As you can see, the whole market took a fat crap right now today. Unbelievable. But anyway, we're going to go ahead and identify liquidity and how to really specify liquidity, where liquidity lies, and it's pretty dang simple. So once you watch this video the whole way through, you're going to literally understand liquidity like a pro by the end of this video. But with that being said, let's go ahead and we're on the NASDAQ booty crack. Just kidding. Okay, so we're going to identify what liquidity is. And so in the markets, liquidity is going to be based on highs and lows in the market where there's a lot of relative equal highs and lows where price is attracted to. Because remember, price is attracted to two things in the markets. What are those two things? Well, price is attracted to liquidity and inefficiencies. So what is liquidity? Liquidity is straight up relative equal highs and lows, right? So if we go ahead and look at this chart here, we're on the 5-minute time frame of NASDAQ here. We had this high, right? We had the crazy uptrend here. And basically, what are we looking for? Well, price eventually has to retrace. What goes up must come down, right? So price eventually has to retrace and actually hit some of these liquidity lows. So basically, liquidity, the more relative equal they are, the more it's likely to get drawn to and get taken out. So what does that mean? Well, if you look right here, okay, on this uptrend, we had a low, we had a same low, relatively equally the same, and then we had this low up here. So I like to identify this as a nice equal low area here where price could eventually retrace back to after a huge uptrend. What goes up must come down. So price will have to eventually take out this low. And hopefully, if we're going for shorts, we would go ahead and see this low taken out too as well. And these ones are really ideal because we have 3 relative equal lows right here. So we want to see these lows get taken out after a huge uptrend. Why? Well, the reason why is because once the market runs out of steam, right? Once the market just keeps going up for such a long time, you see crazy big wicks. Price is kind of running out of steam. Where is price likely to go to? Well, inefficiencies or lows, okay, which is our liquidity. So inefficiencies are, before I talk about more liquidity, inefficiencies are just like fair value gaps, order blocks, stuff that price is attracted to other than liquidity. When price doesn't have anything to run to, it has to run to liquidity. When price cannot run to any inefficiencies because there's no more inefficiencies, right, to run to in the markets has to take out lows and highs. That's called our liquidity. Basically, once the market runs out of steam here, if we go ahead and swipe a little bit, market's making relative equal highs now. Okay, this is another liquidity point. We could go ahead and refer these out. This high, and this high, right? So market comes down. Where's price likely to go to? Well, inefficiencies first, right? Well, maybe. Let's go ahead and see. Well, we have this fair value gap. Price did already run to. I don't really see much, so I would assume these lows need to get taken out because when price doesn't have no inefficiencies like fair value gaps, price has to retrace down, take out these lows. Why? Because a lot of people, when it comes to trading, a lot of the swing people or whatever time frame you're on, there's a lot of people who swing trading or just simply day trading, scalping, whatever the case is. People have their stop losses at highs and lows in the market. So basically, price wants to punish those people whose stops are really obvious. When it comes to making money in the markets, you want to go ahead and make certain decisions in your strategy align with this liquidity, because once liquidity comes down to this point here, that's where stops are easily going to be taken out, other people's stops, right? So just right here, as you guys could see, once a market kind of runs out of steam, starts making a downtrend after a major uptrend, right? What are we looking for? Well, this low to get swept. Why? Because I don't see any inefficiencies, but Just because these are relatively equal, price has to come down and punish these people who have their stop loss here. So the people that went buy up here, somewhere up here, have their stops right around this level. Okay, so price has to come back down, retrace those people who didn't take profits, right? So if somebody took profits here, then they're cool, whatever. But a lot of people have their targets way up here because they're swing traders. So what does price have to do? Well, punish those people. Why? Because when price makes a huge uptrend, what goes up must come down eventually, right? What goes down must come up. But simply because they have their stop loss in such an obvious position in the charts where price has to retrace down into there to take them out. So if we look down here, price eventually comes down and takes these people out. Look at this huge candles. Look at this. See, when price comes in here, there's probably, the reason why it's probably kind of consolidating here is because it's probably a higher time frame for value gap, a higher time frame inefficiency, right? So once price goes to those inefficiencies, price will hit the lows in the market, right? Which is called our liquidity. Look at that. Swept these people with the stop losses, obvious stop losses here, swept those people out, stopped them out. Okay, that's our liquidity point. Another liquidity point, boom. The people who have their stops here, price had to take those people out. And then also these lows here, price had to take those people out. So when you just see these obvious lows and highs in the market, price just has to come back and retrace to that eventually, okay? In another session, in another day, maybe a week from now, it just depends. But price has to punish those people, right, in those obvious areas in the charts. So now once price goes lower, what are we looking for now? Well, to stop those people out, we had a liquidity sweep. That's called a liquidity sweep. When price hits that low, those previous lows here, they get swept out. That's called our liquidity sweep. Okay, when price comes down to those lows, takes those obvious stop losses out. Okay, what is price likely to do? Well, keeps coming down now. Looks like we're going to look for relative equal highs and lows in the market. Do we have relative equal highs and lows? Well, let's go ahead and look still. We have these two highs and this high right here. We have a obvious point liquidity. Looks like it stops, takes out some of these more lower time frame liquidity. Okay, eventually it's going to have to take these people out. Because why? Well, they're relative equal highs in the markets, but a lot of people that are going short, okay, whatever time frame they're trading on, day trading, swing trading, okay, if they went short here, they have their stops here at these obvious level, well, you're likely to eventually get stopped out. Because why? Well, price will actually have to retrace to that back to that area. Okay, for the swing traders out there, they have their profits somewhere down here at some other low. Okay, for swing traders, they have to get punished. So look at, boom, this high gets taken out. This is called our liquidity sweep. And a lot of people, what they do is wait for a liquidity sweep, right? And the markets got to be patient to make profits. So when it comes to liquidity sweep, right after those stops get taken out here from these relative equal highs, well, what are they looking for? They could be looking for inverse fair value gap. Okay, right here we have an order block. Okay, price comes down from that liquidity after they get swept. Okay, and then price retraces back to that order block. Boom, now they go in short here. This is called smart money right here. Okay, this is what smart money would do. Okay, it's wait for those people to get stopped out, then they put their entry proper or in a position where there's more confluences after liquidity sweep, which then gives them a reason. Okay, cool. Now they could identify more liquidity going on the downside, right? So this low here, this is another liquidity point, which price, that's where they have to take profits at. This is what smart money does, and that's how you use liquidity sweeps, right, as an advantage in the markets when it comes from equal highs and equal lows. And that's exactly what smart money would do there. And as you can see, this huge kind of, when price comes down, comes back up here, these lows got swept out. Why? Because, well, there's liquidity here too at these lows here. Liquidity is always going to be lying at highs and lows in the market. So if we go ahead and look at another sort of time frame, let's go with the 15-minute. Okay, you see we got a lot of uptrend here. We got a lot of uptrend. We're creating more relative equal lows and highs because we're on a higher time frame. It's more easier to see in the markets. it's more easier to look at. Well, what do we have? So we have this uptrend here, okay? Right here, we have these equal lows that eventually get swept out here, okay? A lot of the smart money people would buy here after the liquidity sweep based off other confluences too. And then they have their targets at other liquidity. So if we look back in the past, we could go ahead and identify these highs up here. This high is what I'm referring to. I would go on the higher time frame to just set that, take profit, but that's what mainly smart money would look for. Okay. After liquidity sweep, boom, they're long based off confluences on a smaller time frame in here. Okay, pretty dang simple. So once you apply this in your strategy, you're actually going to make so much more money because you're going to be, not in drawdown as much. Okay, when you have your stop losses at a specific area in the markets, in the charts where it's so easy where other traders could replicate that stop loss, that's when, you're going to get stopped out. Okay, the retail traders get punished. Why? Because of these large banks and industries wanting to take out these easy to look at lows and highs, right? The reason why they take out the highs and lows, because why? Well, the reason why is because a lot of people have their stop losses there. Pretty dang simple. If the swing traders out there are doing a trade, maybe buying up here, now their stop's going to be at this low. Well, what does price have to do? Come down, take those people out. You see how price takes those people out. Then right here, we get a small retrace, and then we get price coming down to more liquidity lows. This is what price is attracted to. And I know you're probably blown away right now. Your mind's probably like, whoa. When it comes to learning how markets move, remember, how do they move? Well, the markets move based off two things, inefficiencies and liquidity. So after liquidity is swept, what is price likely to do? Well, hit more liquidity down here, but look at inefficiencies as well, right? So inefficiencies are gaps, fair value gaps in the markets, order blocks, whatever it is. Price is also attracted to that, as well as taking out those people, right, with a liquidity, right? Look at right here. These equal lows, okay? Look at low here, equal lows. Price comes up, eventually has to take those people out that are long, that have their stops in this position, okay? So where's price likely to go to now after those people get stopped out? Well, price will go to this gap right here because it is inefficiency. All right, with that being said, everybody, hope you guys did enjoy this video because this is straight gold right here. If you're in a gold mine and, honestly, personally, I don't even want to see gold in the gold mine. I want to see this crap because this is going to get me infinite amount of money. If you simply know liquidity and actually put this and have it aligned in your strategy, oh my gosh, literally, you're going to be making profits and you're not going to get stopped out as much anymore because where liquidity and simple people put their stops at, where obvious people are putting their stops. So not to put your stop loss there, right? So with that being said, guys, I hope you guys did enjoy this video and happy for you that you learned this and made it this far because this is straight pure gold. With that being said, take care, everybody. Hope you guys all have a great day. Take care. Peace out.